I can't imagine buying a house right now at those elevated rates. What's your outlook when it comes to mortgage rates? Do you expect them to stay elevated throughout the rest of the year? And how does that impact prices? For example, Zillow says they're forecasting prices for homes to go up 5% this year.
All right, so if you were waiting for interest rates to come down so you could buy a house, it looks like that's not gonna happen anytime soon, and buying a house might actually get more expensive later this year because the Fed is gonna continue to increase interest rates.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
And this week, the chairman of the Fed, Papa Jerome Powell, has told us that he's gonna pause interest rate increases for the first time in the last 15 months, but that later this year, we should expect at least 2 more potential rate increases. Now, why are they pausing and what are they waiting for? They're waiting because remember all those bank failures that we've had this year? That happened because interest rates went up too high, too fast. So parts of our economy ended up breaking. And in their most recent official statement, they're telling us they want to wait to see how much more stuff could potentially break in the economy, like hiring, inflation, and lending from the banks before they increase their interest rates even higher. But so far, we could expect at least 2 more potential rate hikes at 0.25% apiece. And that just depends on what happens to the economy, but that also means that buying a house will be that much more expensive.
There are many problems in the modern housing market, but the biggest one for Americans tends to be the price.
Prices rose 40% from the start of the pandemic.
So in today's video, I want to get to the bottom of the problem and explain exactly what's going on, so let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the regrets. Don't you wish you could time travel back to the year 1998, when you were probably in like 3rd grade so you can buy a house when they were actually affordable, but instead you chose to waste your life on the playground and collect all those useless
Pokemon cards and Pokemon.
If I could go back, I would do it all over again and save enough for a down payment. Anyway, there's some good news and some bad news. The good news is that as of the latest data from this week, inflation is now at its lowest point in the last 2 years at 4%, meaning prices are still going up, but now only by 4% per year. Now the bad news is buying a house is potentially going to get more expensive. Now, I have to warn you that I'm not a real estate agent, I'm not a professional, I'm just an amateur trying to understand this stuff by looking at the data, but it's kind of crazy to see what happened in the last few years. In January of 2019, the median sales price in the US was only $313,000. At that time, the average 30-year interest rate was about 4%. That's a monthly payment of about $1,500. Now let's take a look at those same numbers today. The median sales price is now $436,000, and interest rates are 7% for the national average 30-year mortgage. That's a monthly payment of $2,900. That's a 93.4% increase, or in other words, almost double. But did incomes double in that same time frame? And that's a rhetorical question because no, of course they didn't. In fact, hourly wages went up from $27 an hour to $33 an hour, which is only about a 21% increase. Now here's what's crazy. In order to afford a $2,900 monthly payment, banks require that that amount of money should be no more than between 33 to 36% of your gross monthly income. Meaning you have to make at least triple that before a bank will even consider giving you a loan on it. So that means $8,700 a month, or at least $104,000 per year, which of course the average person isn't making right now. And that means the middle class is now completely priced out of buying just the average house. And there's a lot of reasons for why this happened in the last couple of years. The government printing trillions of dollars and increasing interest rates is just one of the reasons that's making it more expensive right now. In my last video this Monday, I said there was a 70% chance that the Federal Reserve would pause interest rate increases, and that's exactly what ended up happening. I'm a genius. No, I'm not. I just looked at the data and the market happened to be right. And now the market data is telling us there's a 71% chance that interest rates will go up by 0.25% in July. Another reason homes are becoming more expensive is because wages are not keeping up with inflation. Because even if you're getting paid more at work, if groceries and the cost of gas is going up by even more, then you're not going to be able to save as much for a down payment. And that's exactly what we're seeing in the data with the personal savings rate, which has gone down significantly from the highs of the pandemic. And then of course, a shortage of housing is the other reason. Just 5 years ago, the middle class could afford roughly half of all the homes that were for sale on the market. But today, it's way worse. If you assume the average person makes $75,000 per year, which is a pretty big assumption, that middle class could only afford 23% of the homes currently on the market. So the shortage is probably even worse than what we think it is, because most of the competition is happening in a super concentrated price range where most people are competing because that's the only thing that's affordable to them. But now, there's another potential reason that people are starting to look at.
Some members of Congress believe Wall Street is a part of the problem.
What's outrageous is your tax dollars are helping Wall Street buy up single-family homes. You're subsidizing Wall Street.
Massive private equity firms like Blackstone and Pradium Partners have backed a relatively new breed of homeowner, the corporation. This growing industry buys or builds single-family homes and then rents them out.
Now, this is one of those things that I do want to tell you about without necessarily saying that this is the main reason for it, because it's not, at least not yet. But it is getting worse.
As of 2023, corporate landlords only command a small portion of the rental housing in this country. The vast majority of all rental units, including apartments, are owned by individual, small-time investors. But there's growing focus on single-family homes.
So these big hedge funds and institutions and companies like BlackRock that we're recently hearing about are only responsible for about 1% of all the rentals across the entire country and 2% of all the single-family rentals. But those numbers are slowly growing, and it's thanks to a handful of these companies.
There's a small but mighty group of companies that lead the industry.
So Pretium is the parent company for a company called Progress Residential that owns about 90,000 homes. They were started by Don Mullen, who came out of Goldman Sachs' mortgage group. Invitation Homes was started by Blackstone, but Blackstone sold their position a long time ago. They own about 80,000 homes. American Homes for Rent, which was started by Wayne Hughes. They own about 60,000 homes. There's a company called Tricon Residential that's out of Canada. And then there's one called Amherst. Those are the big five.
What's interesting to me is that when I hear numbers like 80,000 homes, I think to myself, Wall Street is buying everything, right? But in context, even those numbers represent a small 1 to 2% of all the rentals in the US. But my worry is that those numbers are gonna grow. In 2021, for example, 28% of all the houses sold in Texas were bought by corporations. That is not a small number. That's like saying 4 people are trying to buy the same house, but one of them was a corporation. Which one do you think is gonna win? And you can see in this map, it shows all the corporate activity across the US, and I think these numbers for corporations buying single-family homes will probably continue to go up. And that's because their rental rates are going up faster than the rest of the country.
Rent hikes for single-family homes in this region have outpaced other parts of the country. Since the onset of the pandemic, rents for a 2-bed detached home increased about 43% in Phoenix. They're up 44% in Tampa and 35% in Atlanta. That's compared to 24% nationwide.
After the pandemic, people saw the opportunity to go into these lower income neighborhoods, working class neighborhoods, buy up these houses and in communities that the working class can afford. And they're holding these houses, often for years, taking them off the market, making it even harder for young people and working class families to own a house.
Now you might be wondering, what's the end goal for all of these companies buying up our real estate? Their end goal is to show enough short-term cash flow so that they can take a company public and then sell it for even more money. Because so far, BlackRock is making bank with this strategy.
The company's real estate income trust delivered an 8.4% return on investment in 2022. This in a year when the wider stock market declined nearly 20%.
This is a problem that's going to probably continue to get worse because right now, interest rates are pretty high, which means buying treasury bonds is a lot better than buying real estate. It's much better to just collect that 5% interest for doing nothing. But when interest rates come down, which eventually they'll have to, which is what everyone is waiting for, that's when those hedge funds could get desperate for their yields. And when that happens, real estate starts to look a lot more attractive than buying treasury bonds.
Analysts write that by 2030, institutions may own 7.6 million single-family rental homes. That could be more than 40% of the market. But that's a big if.
The if sort of depends on what happens to interest rates and the stock market. If the stock market is not an exciting place to be and stocks go sideways for the next few years because there's no exciting narrative like AI or crypto or some other tech boom, and if interest rates on bonds are not that high, then the next safest and best place to generate a yield will be real estate. And the strategy is pretty simple. Create a corporation, fund it, buy up real estate, increase rents, show the cash flow, and then you profit by taking the company public. So the question is, what can we do about this problem in the future? Back in the 1970s, the US used to build over 400,000 entry homes per year. Fast forward to 2020, and we built only 65,000 homes. Not to mention that our population is growing at a faster rate than the rate at which we're building homes. Now, one solution that people are proposing are to give more tax breaks to the corporations.
Some experts believe the best way out of this problem is not to limit corporate landlords, but rather to do whatever it takes to build more housing.
Some of these big REITs, these landlords, are actually building homes. They're adding to the supply that we desperately need.
Experts believe this trend could help, but it needs far more time to prove its value.
One side argues that we should give more incentives to these corporations so they could build more homes. The other side argues that we should tax those corporations even more if they own too many homes.
Some members of Congress believe limiting corporate activity in the housing sector is a good first step.
Wall Street is going to buy up a single-family home, and it's vacant for a couple of years. We're going to tax it, forcing these firms to sell that back into the market. What we're saying is don't have private equity buying up single-family homes. That's going to mean there are more single-family homes on the market.
And like most things, the real solution is probably somewhere in the middle, because there do have to be tax incentives and tax breaks for those corporations to build more homes. But also, we could potentially incentivize commercial real estate, which everyone is expecting to collapse. What if we incentivize those smaller banks and corporations that volunteer to convert some of their failing commercial real estate into residential real estate? And the ones that do could get a preferable tax break or a lower interest rate when they refinance, so they wouldn't have to lose their properties and people would have access to more homes. It's a win-win, but maybe I'm naive and I don't know what I don't know. But at the end of the day, even if nothing else, and if Congress can't figure out what to do, then the only thing to do is what's within our control, which is to lower spending and to increase our income. And you can significantly increase your income just by switching companies every couple years. And if you can combine that with living below your means by maybe renting, not your dream house, but something to hold you over, which despite what some people say, I don't think is throwing money away because it gives you the flexibility to move in case a better job opportunity presents itself, then I think you can save up really fast for a down payment. My philosophy, though, has never been to try to time the market with interest rates or finding the bottom of the price. Instead, run the numbers, and if they make sense for you today for the next 15 or 30 years, then it makes sense to buy, no matter what time it is. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon, bye-bye.